Harsha Upadhyaya joins us. Let's connect with him to talk about markets. Let's talk to him about what his view on valuations and where he sees the real economy is headed. Harsha, good morning. Thank you for joining us. Harsha, we are going through a patch where it is getting difficult to justify the economy and the markets now. So where are we in for a nasty surprise from markets as they will realize that economy is still weak, or are we in for a positive surprise for economy which will justify the run up in the market? Because somewhere the beam balance has to balance, Harsha.
Nikunj, if you see some of the high frequency indicators that have been coming through, there has been a significant improvement on a week on week basis, month on month basis since April lows. For example, electricity consumption last week is up 12% year on year. If you look at e-way bill generation for the last week, again, it's one of the highest numbers that we have seen in the recent history. It is up 20% on a daily average basis as compared to the daily average of financial year 20. The numbers are at about 2.1 million transactions. Clearly, some of these high-frequency data and information that's coming in is supporting the euphoria that you are seeing in the market. But at the same time, the valuations are not cheap. As you mentioned, the valuations have moved up beyond the 10-year averages, I would say. Some part of it is justifiable because whenever you see markets bottoming out, usually the markets discount something well ahead of time. And to that extent, at the bottom, you may not really see the lowest value. Same thing happens in commodity sectors, and now we are seeing in the entire market as well. Having said that, I think it is not prudent to chase momentum because next 4 to 6 weeks would be very crucial in terms of how our economy shapes up. We have seen COVID cases coming off quite significantly in the recent past. Whether that trend holds or not will be visible post-festive season, and that would be key for overall economic recovery. So to that extent, I think the jury is still out in terms of where our economy is headed. So a bit of caution may be warranted at these valuations especially.
Okay, I'm just going to put a sheet out or a graphic out as to what have been the last big purchases of Kotak AMC, aggregate data based on what we got for the month of September. This is October, the fact sheet is not out. Harsha, let's look at where you've been booking profits and where you really have been making some changes. You bought into autos and you bought into corporate banks while you booked some profit in large cap IT and large cap pharma. Is this just a view on the sector, or you think it makes more merit now to come back to domestic cyclicals, industrials and inward looking sectors?
Kunj, I think as economy starts to gain ground in terms of stability and revival, we would obviously shift more towards some of the cyclical names, but obviously at our preferred valuations, not at any price. What you've seen in terms of changes in the recent past is not so much about just the business, it's also about the valuations where some of these sectors and stocks are trading. I think we did make a very good absolute gains as well as good relative outperformance from being in sectors like pharma and IT in the last 6 months. So we have booked some profits there and moved into some of the cyclical sectors where depending on the economic recovery, you could see further re-rating. As I said, right now it's very difficult to take a complete shift towards cyclicals as we are still in the middle of a pandemic. And depending on how the data comes out over the next 4 to 6 weeks, and depending on that evidence, we will take further call on increasing one basket over here.
Harsha, you come from a school of thought where you follow value investing, which is buy things which are cheap and they're trading below its intrinsic value. Without getting into a stock specific conversation, I'm using stock as an illustrative example here. State Bank of India, ITC, NTPC, BEL. Why are these stocks trading at such rock bottom valuations? There is a value case for some of these stocks for many years now, but markets are not acknowledging them. What is happening is that the P multiple for a Nestle or Asian Paints or HDFC Bank, it keeps on expanding. So for those who try to follow a purist and a classic value investing theory, they are feeling slightly left out, defeated, or trying to understand that why markets are not recognizing the intrinsic value of some of these companies?
Sure, but there may not be a common theme across all the value stocks. They are beaten down for various reasons. But to us, one thing is very clear. We would invest into any of the so-called value stocks only when we believe that there is some other fundamental factor that's going to change. For us, any change in terms of the management approach is required, or if there are non-core businesses and because of which the overall stock or the company is getting affected in terms of valuations, then there has to be monetization roadmap for that particular non-core business. So some of these things are necessary for the valuations to change, in our opinion. Otherwise, on Excel sheet, you can keep looking at it saying that it's very good value, high dividend yield, etc. But until and unless something changes for the positive, we are not sure whether the markets will recognize that and give a higher rating. So to that extent, we have been very cautious, not now, even in the past, in terms of betting on just the value. We would like to see some other fundamental catalyst coming through. And if that happens, then I think it will be good to see some of these stocks in the portfolio, and they are likely to outperform. But without those fundamental triggers, you can continue to look at valuations and hold on in the portfolios, but it could be more of a value trap rather than monetizing some of those values or unlocking those values.
Okay, so in light of that, Harsha, while you're kind of waiting to see how things stabilize, would you maintain just a cautious approach, or would you, because things could kind of turn on their head given that we don't really know where we're at the moment, if we're not completely buying into the science of a consistent recovery?
True, but if you're referring to cash levels, we are fully invested because that's been our investment policy, that we will not hold too much of cash in the portfolios. As we all know, timing the markets is very, very difficult. So we do not currently have much cash in our portfolios. But when you look at our portfolios have a good mix of, I would say, resilient pockets of the economy, which have been largely unaffected due to COVID pandemic, that is IT, pharma, FMCG, etc. And we have also had a reasonable position in many of the other cyclical sectors, which are at various levels of improvement at this point of time. And as more evidence comes in terms of further recovery or otherwise, then we will be able to take a bet on one of those pockets more meaningfully, I would say. So at this point of time, we are well diversified and fully invested.
Okay, and what would you completely stay away from at this point? Would pockets like real estate, even smaller pockets such as aviation, anything else in terms of some of the more beaten down parts of the economy, would those be a clear avoid, or would you still be looking for selective opportunities?
No, we are looking at some of these opportunities very keenly. We do have them in some of our portfolios. For example, many sectors which are under some sort of a restriction still, for example, aviation, or where the activity levels have not really resumed back to the old normal levels. For example, the entire real estate construction piece is something that we are holding in our portfolios. And we believe as there is more confidence coming on the economic activities, slowly you will start seeing more resumption of work in these segments as well. And that should help re-rating of some of these stocks. But again, it's not a top-down sectoral approach that we are taking in some of these sectors. We also need to be sure that some of these balance sheets will be good enough to really sustain the adverse impact of the pandemic in case there is second spike or if there is continuation of the pandemic. So to that extent, we have been more stock specific in some of these sectors which are still not at 100% normal levels.
Sure. Harsha, what explains the underperformance that we're seeing in telecom incumbents? While it's inevitable that tariffs are going to move up and there is impending 5G, which is only going to take time as long as perhaps 4 to 5 years, who knows how long. But then again, irrespective of all the vision, all the bullish calls in the street, you haven't seen these stocks perform much.
True. I think there was a school of thought which believed that the competition would reduce because some of the players were seeing serious financial difficulties, and the market expected a big consolidation in the industry in favor of maybe the top two players, and that seems to be not happening at this point of time. And also the point that the tariff hikes are delayed is also affecting the sector. And our view is, since we're in the middle of the COVID pandemic, it's very unlikely to see sharp increases in terms of pricing in any of the sectors, whether it is business to consumer or business to business. Very unlikely that you will see very sharp increases in terms of. So to that extent, I think the improvements that were expected for some of the players in the telecom is pushed to a later date. So to that extent, I think markets have not really reacted positively to some of these names.
Harsha, I was just looking at SBI Card's earnings and just the quantum of defaults, the hit that they've taken in the second quarter. What is it telling you about the kind of NPA picture and the hit that we could see on the retail end of not just NBFCs, credit cards, but banking per se?
I think it is something that one needs to be cautious about, and that's what we've been saying in the past as well, that while the cases have been coming down significantly in the recent past, but there could be some ill effects of the pandemic in terms of repayments, in terms of servicing of loans, etc. So to that extent, it's still very early to say that there would be no impact on the financial sector because of what has happened. And if you look at the banking sector as a whole, I think we are still in the middle of the restructuring period. We will get to know only when all of these restructuring cases are kind of arrived at, and the final impact on the asset quality is which could be a couple of quarters away. So to that extent, right now, to take a view in terms of recovery or on asset quality, it is a bit too early. And that's where I think market is also a little uncertain in terms of positioning in some of these financial names.
Harsha, now we can look at HDFC Bank numbers and say that there is no problem in the world. They're firing full cylinders. Or we can look at SBI card numbers and say, look, there is a big problem in the world. People have lost jobs, and there definitely is going to be a problem in terms of collections and retail delinquency. So what is the real world? Look at the world through the eyes of HDFC Bank, or look at the world through the eyes of SBI cards?
See, clearly the world is somewhere in the middle, I would say. There are some companies which have performed very well. There have been companies which have had bad asset quality issues. And this situation is likely to continue even for the next few quarters, I would say. It's not going to be one-way clear recovery that you will see. That's the reason why market is also differentiating between some of these financial stocks which have lesser asset quality issues and adequate capital to grow whenever the revival starts to gain more momentum. But many of the other financial stocks are still not showing a similar kind of stock performance, because obviously there are question marks in terms of their ability to wade through this difficult space, as well as how they are placed in terms of future growth whenever recovery sustains. So to that extent, I think market is already making a distinction between some of the players who have managed their business well and who are likely to continue on that path, and the others. So I think as you go ahead, depending on how you believe the economy is shaping up, you could take bets on any of these two buckets, as I mentioned earlier.
What if the US presidential election outcome is not clear? What if things get prolonged in the month of November? What is if there is a veil of uncertainty, let's say, for next couple of weeks? Could that be a very big risk-off moment for global markets? Do you see a swing of 5, 7, 10% coming? Or I'm exaggerating it?
Nikunj, it's always difficult to predict some of these short-term movements. But generally, the elections or any such events have had an impact at the most in those particular period, maybe for a week or even less than a week in some cases. For example, today we do not even remember how the markets had reacted in 2016 when US elections had happened. Let us recall, when the elections took place, there was nervousness, markets fell. Even in India, we had demonetization announcements, markets fell. But after that, I don't think for much of the rest of the next year, we really worried about demonetization or the political implications of US elections, etc. So I think depending on how the market is positioned, whether it is heavy or light, and what is the general consensus that's built up, and the actual results or the actual outcome of an event will decide the volatility during that particular phase. But over a longer term, we have hardly seen some of these really changing the course or having an impact on the long-term trajectory of the market.
Thanks so much for joining us this morning, Harsha. Pleasure as always.
Thank you.